Right, I'm going to get started on the subject. Yeah, we're on YouTube as well, and I'm going to start the recording. Let's have a look. Um, yeah, so we're recording now. What we'll do today as we're going along, um, as the subject is maybe a little new to some people, and maybe also, yeah, there's going to be more questions. Yeah, feel free to raise your hand or ask a question as we're going along on this one. So we're talking about commercial property investments. We're not talking about things like commercial to residential, but we're talking about pure commercial property investments. And we're going to be, it started off, in fact, with 5 advantages. And as I was like recording stuff and speaking with other people, it's ended. Obviously, we could probably make lots more, but we've ended up now with 7 specific advantages, benefits of commercial property investments when compared to residential property investments. So what is a commercial property? Basically, a commercial property, I was going to say, is anywhere where people don't live. I'm going to say anywhere where people don't live permanently, because if we look on here, we do have one type of commercial property is leisure, which includes hotels and restaurants. So the main uses or the different classes of commercial property, we've got offices. That's obvious what that is. It can be small offices or large offices. Retail, which is shops, shopping centers, can be also like pop-up shops as well. Or industrial covers like a lot of things. It can be large warehouses, factories, workshops, through to light industrial, or what we call like multi-use facilities. We'll speak a little bit more about that as we go along and on the examples, because one of the areas where we like to specifically look at and invest in commercial property are these multi-use facilities, which can be like light industrial. So it can be industrial, unlike industrial estates typically on the edge of a large town, large or medium-sized town. And could be like a building or a few buildings which contain a number of different units. And those units can be used as like workshops, can be used for like small warehouses for people selling stuff on Amazon and eBay, or they can be used by like specialty gyms, dance schools, all sorts of different things. Can be like sometimes cafes there as well. We like those because it's like the commercial equivalent of an HMO. So it's like multiple commercial occupants. So that reduces the risks if there's a problem with one occupant. We'll also see that in commercial, those risks are a lot less important or critical than in the case of residential. Then we've got leisure, which is hotels and restaurants. And then mixed use developments is a combination of basically all of the above, probably except industrial. So mixed uses, we can have shops, shopping centers, and then above and around, we can have a mix of offices, and in this case, it would be residential accommodation, potentially hotels or serviced apartments as well. So yeah, commercial property remains a strong investment choice due to stability and potential returns. So we're going to get into some of the advantages. So first advantage is stability of legislation. If we're talking about residential property, we know it's both highly regulated, can be very complex, the regulations when we're renting out properties. Even single lets, HMOs are a lot more complicated, and legislation is changing frequently. What we've got here is like the list of, since 1997, Rent Act 1977, that was superseded by the Landlord and Tenant Act 1985. Additional Housing Acts 1988, 1996, 2004. Other acts 2015, 2019, and we all know that there's the Renters' Rights Bill that's currently going through Parliament and the House of Lords. So yeah, we have to, if we're doing residential, we have to keep up with everything that is happening. Also tax changes. And so yeah, there's less stability, and we don't know what things are going to be like in 2 or 3 or 4 years' time. Obviously, in residential, people always need somewhere to live. So there's always going to be a demand, but it's a question of navigating a lot more, amongst the changing legislation. Commercial property legislation, however, is quite different. Almost everything today is governed by this Landlord and Tenant Act 1954. So we're talking about an act 70 years ago that hasn't been changed. So we know exactly where we are in commercial law, commercial property law. It's probably a lot more balanced between tenants' rights and landlords, owners' rights. And also, if, for example, a commercial tenant stops paying, typically it's 1 week or 2 weeks notice, and then we can go in there and change the locks and actually remove anything that the tenant has left there, and sell it if there is unpaid bills. Yeah, so fewer restrictions on eviction. Rent adjustment is much easier if it's been properly put in the commercial leases. So that's advantage number one, stability of legislation. Advantage number two, longer leases and professional tenants. Typically, commercial leases start from 5 years, and they can go, 25 years is probably quite long, but it's not unseen. Can go from 5 years, 10 years, 15 years. So that's giving long-term income stability, especially if it's a good, reliable tenant that's got like a good balance sheet in their company and a good business model. Typically, leases will include annual rent rises following consumer price index or retail price index, and then also reviews. Probably in general, we put that every 5 years. For reviews, we call it, in inverted commas, based on market conditions. So that is based on like how the market is as defined by qualified surveyors. Tenants tend to be businesses, so we're generally dealing with people who are used to dealing with contracts, used to respecting agreements, normally used to paying on time. So advantage number two, longer leases and professional tenants. Advantage three, higher yields when compared to residential. Obviously, when we're doing creative property deals in residential, or if we're doing HMOs, which are more intensive in management, we can get yields higher than these typical 5 to 8%. But 5 to 8% are the typical buy-to-let yields across the UK, depending on the regions. And if we're in London, we're going to be 2 to 3%. So residential property, we can see what that's giving. Commercial property yields, typically we're starting at 7%, and quite easily we're able to, if we're selecting carefully the properties, we can get into 10% and higher. And we've got the regular rent reviews and rent uplifts that can be in the commercial contracts. Advantage number four, tenant responsibility for maintenance. Obviously, one of the things that residential landlords are often speaking about is boilers breaking down, problems with electricity, problems with plumbing, problems with damp, all sorts of different things. A lot of them, the landlord's responsible for fixing them, for paying for them, for organizing them. In the case of commercial tenants, so commercial leases, most of them are what's called, this is a specific term, fully repairing and insuring, we say FRI, which means that the tenants are covering all the maintenance costs. So anything that goes wrong inside the building is the responsibility of the tenant. Obviously, there's a precise state of the building that's recorded at the beginning and at the end of the tenancy, which could be 5-10 years. Sometimes it'll just keep on renewing. Then that the property has to be given back in the same state, and if not, there's adjustments that are made. If it's a complete building, so let's say, for example, it's a hotel that which we own, so that's the commercial property, but we're not managing it ourselves. We're renting it out on a long-term lease. Typically there, the tenant will be responsible for the complete building. So that includes the roof, the walls, the structure, and must be maintaining that in good condition. So that really it's a massive advantage in pure commercial properties. Yeah, so tenants paying for property upkeep. Obviously, tenants are paying for utilities. Tenants are paying also service charges, especially if it's like multi-block industrial units, which means in reality, the tenants are covering most of our ongoing management costs. So yeah, the management costs are going to be quite small, whereas we know that if it's in residential, then we've got the letting agent fees, which will be probably 10-12% if it's a standard buy-to-let, 15 or 18% if it's an HMO. And tenants are also paying for the insurance contributions, so we're actually paying the building insurance. In a lot of cases, we set in the contract that the landlord is paying the insurance to ensure that the building remains insured, but those insurance costs are then rebilled to the tenants. So yeah, tenants' responsibility for maintenance keeps it a lot simpler and yeah, increases the profit. Advantage number 5, diversification. Obviously, this is more for people who are already doing a lot of stuff, a lot of property investment in residential. So residential, as we saw at the beginning, subject to like changing legislation, can be some risks and like, yeah, adapting. Obviously, if we're doing business, it's always a question of adapting to new circumstances. But having commercial property in the portfolio is diversifying, yeah, and reducing the risk, because we've got two different like economic areas. And mentioning also as an aside, commercial properties can be purchased and held within SAS pensions. A SAS pension is for people that own businesses, so they must own their own business. They can create a self-administered pension fund, so their business can contribute into that pension fund, and that pension fund can invest directly in commercial property. Pension fund can't invest directly in residential property, but can invest directly in commercial property. So yeah, there's advantages there, and all the income and profits that a SAS pension fund makes are not taxable. So yeah, diversification is advantage number 5. Advantage number 6, refinance opportunities based on commercial valuations. Generally, if we're talking about residential property, so it can be a standard buy-to-let, even if we've done like a block of flats, multi-block units, or we've done a block of, for example, serviced apartments, it's almost always going to be valued based on bricks and mortar. So based on the actual building and the structure itself, and based on the comparable, sale. So if a surveyor is coming in to give the valuation of a residential property, it's going to be looking at similar properties that have recently been sold, make some adjustment depending on condition, potentially other things like desirability of the area or the property, but it's always based on the property. Commercial valuations are not based on the bricks and mortar. Commercial valuations are based on the rental income. They're based actually on two things. They're based on the rental income, and they're based on what we call the commercial yield, which is a sort of magic figure, which depends on basically for a specific type of tenant. So there we have what we call strength of covenant. If it's a tenant like, for example, Costa Coffee, like Boots Pharmacy, things like that, then they're considered like a very reliable tenant. So that means that the expected yield, because the tenant's reliable, we're like sure of getting the income. So the expected yield actually is going to be low. It can go like maybe 5 or 6%. If it's a individual business, for example, an individual computer shop, let's say, then there's a higher risk of that business failing. So the yield there is going to be higher because there's someone renting out their property is expecting, needs to get a higher yield because of the risk of renting to that type of customer. So we've got the rental yield, and the valuation of a property is the income divided by the yield. So to take a simple example, if we've got income of, let's say, £100,000 per year, we've got a commercial yield of 10%. So we've got 100,000 divided by 10%, and that makes 1 million. If, however, we've got a, let's say, a more reliable, more well-known commercial tenant in there, and because it makes the calculation simpler, we've got a commercial yield of 5%. 100 divided by 5% makes 2 million, and we've actually doubled the commercial valuation. So by buying a property that is maybe underutilized, maybe if it's a multiple unit industrial block, maybe we've got some vacancies, so we're going to look for good tenants. We're going to be negotiating rent rises if leases come to an end. We're going to be putting in leases that obviously there's some negotiation in there. We need to understand how far we can go, but we're looking obviously to get maximum income and profit from that. And as we increase the income, obviously it's good that we've got the ongoing income, but that also enables us to get a higher valuation. And the valuation is used, of course, for bank lending. So typically, if we're buying a commercial property, if we buy it at the right price and we've got scope to improve the income, generally within 3 to 5 years, sometimes 2 years, but let's say within 3 to 5 years, we can refinance. Typically on commercial properties, we're financing at 70% loan to value. We can't get 75% like on commercial. So we're talking more about 70%. Ideally, sometimes if you can go a little bit lower, like 65%, we can get better interest rates. So if we're talking about 70% loan to value, if we're increasing the income by 30% over 2 to 3 years, then we're able to refinance and get back out all the deposit money. And that's the same thing when we're doing HMOs in residential, but that's the only residential where we can get a commercial valuation. So massive advantage number 6. And then last one, advantage number 7, potential tax benefits. Some benefits we already know about. Residential property that people bought maybe 5 years ago in their personal name, not through a limited company. We know this thing called Section 24, which means that the mortgage interest payments that residential landlords are paying can no longer be claimed as expenses and deducted from tax. So if a landlord is getting, let's say, £2,000 per month income from a residential property, they're paying a mortgage of, let's say, 1,500. What that means then, that 1,500 is not deductible. So they're paying tax on that 2,000 income per month, not on the real profit, which is 500. And in cases like that, it's possible to end up with negative cash flow. So we don't have those problems in commercial. And I'm going to say it's very unlikely that we're going to have those problems, because commercial property is taxed in exactly the same way as any other business. So it's not possible to specifically penalize people investing in commercial property without penalizing every other type of business. So yeah, we've got generally better tax regimes, capital allowances. I'm not going to go into detail for that, but a lot of the expenses that relate to, like capital expenditure, that relate to plant and equipment, things I think like fire alarms, a lot of the services inside a building, we can claim capital allowances on there, which reduce or remove sometimes for several years the corporation tax that can be due. And the other thing, yes, stamp duty, land tax. Commercial property is quite a lot lower than on residential. It can be up to, when we're looking at higher price buildings, if you're looking at, these are only very, very approximate. If we're talking about £1 million residential property, we've probably got something like 80,000 of stamp duty. If we're buying a £1 million commercial property, yeah, we probably got something like 40,000. Don't like sort of repeat and quote those figures there, just very approximate to give an idea on that. So yeah, tax benefits in commercial property can be a big advantage. Challenges to consider: knowledge and experience. People that have, like, over the years acquired knowledge both through doing things and education, speaking with other people. And it's fairly easy. You can go online and subscribe to my BRR, for example, training course on residential. There's other ones that exist as well. There aren't so many courses on how to manage a commercial property. And in practice, managing a commercial property, it is a skilled job. And there are professionals that do that very well. It's obviously important to understand how things work, but it also makes sense to employ, commercial, I'm saying the commercial agents, but people, like commercial surveyors who have experience in commercial asset management, who can, properly manage them, understand how to set up the leases in the most favorable way, can also help significantly in negotiating a good price. So don't be afraid of not having knowledge and experience, but don't try and do it yourself. We're going to look, after any questions, if there are any, at a couple of examples. And these are a couple of deals that we currently have available. They're not ones that I went out. Obviously, most of you know that my experience is, got some experience in commercial, but it's primarily residential and commercial to residential conversions, things like that. So for the deals that we're currently sourcing and basically presenting to people, specifically SAS pensions are looking for commercial investments. I'm doing this with a business partner who's got something like 15 years of experience in commercial property management. He's got his own, started a couple of years ago buying his own commercial, these light industrial mixed use blocks. And so when we're offering proposing deals that we found, we've probably been able to negotiate a much better price than someone that doesn't have that experience and sort of knowledge, and can go in and say, look, this is how this is what the real value of the property is, this is how much we can pay, and to use the arguments to explain that. And then going forward, the deals that we have, in the figures, we've got the management fee, which is standard management fee factor is 10%. We're doing this at 9%, just below. And obviously this is professional management. to get the most out of the property. And also, as we were talking about for the refinance, it's yeah, increasing as fast as possible the income, and therefore increasing the potential for revaluation and getting all the money out. So yeah, don't shy away from using professional services, and yeah, and if you're doing that, there isn't any real reason to be concerned about knowledge and experience. So as a conclusion, commercial property remains an attractive long-term investment, stable rental income, capital appreciation, tax efficiencies, and hands-off maintenance, because yeah, the tenants are looking after that. And yeah, always a standard thing, investors should conduct thorough due diligence and seek guidance to maximize success. That's one of the reasons that we're here. It's to yeah, give guidance. We do offer consulting and yeah, assistance in building up both residential and commercial property portfolios. So we're open now to any questions. Does anyone have a question? I'm just going to check if there's any questions on the YouTube. Any questions from anyone?
Trevor, have you got any examples of deals that are currently obviously lesser sensitivity? Have you got any examples of any deals that your partner's done as examples? So
We will actually be sharing an example because we do webinars also on Thursday. And on the Thursday one, we'll be digging a bit deeper into some of this commercial stuff. And there we'll actually be going through a real example of what he's done. And I'm going to present a couple here, only very briefly. On Thursday, we'll actually, both for these two that I'm going to present here, we'll be looking at the, because what I'm going to present is our nice glossy brochures with the overview of the figures. But behind the outline figures, there's probably something like 50 lines of Excel and all the breakdown of that. Unlike, for example, when we're talking about the potential increase in income and commercial valuation, we do that over the first 5 years. When we talk on these are multi-unit blocks, and we've actually got we've got the current occupancy of the blocks. We've looked at the different leases on each one, and then we've got the expectations for the increases and increases in both occupancy. We see the leases that are coming to an end, and we know we can be justified in increasing them. Yeah, so we've got all those figures, and we'll be sharing that in more detail on Thursday. But once we've seen if there are any more questions, I'm going to be showing those very briefly. Does anyone else have any questions? Right, I'm going to stop the share and share something else. So this time we're going to share the brochure. Can everyone see this on the screen?
yeah.
Okay, good. Right, so there's a couple of properties here. We went to see these probably something like 2 or 3 weeks ago and had a look around, met the one of them we met the owner, the other one we met the agent. They're both actually quite different, but they're both good investments, different figures, and also a question of what people like, maybe have a better feeling for one rather than the other. So the headline here is like low risk investments in already income producing commercial property. Generally, people who know me know that I like things that have got relatively low risk. Obviously, we're taking some risk because we're seeing how we can add value, but we're not doing things where, well, let's say like completely ground up, or buying a commercial property that's completely derelict and we don't really know how well it's going to perform. Here we've got good ideas of current performance and potential for potential for improvement. So what we've got here is this is in Bradford. It's quite close to the city centre of Bradford. It's an old mill. Obviously, there's lots of old mills in that area that's been converted into, here it's actually serviced office space. So yeah, it's currently fully let, 11 tenants in there. Potential to increase some of the rents, optimize some of the leasing, the leases. And if we look at the figures for the, so you obviously we've got some pictures that show a bit what it looks like inside. There's the old brick wall, some of the beams, but it's done out to a really nice standard. So this is often, there's not a massive amount of work to do on this one. There's basically nothing to do. It's a question of buying it. The owner wants to retire. It's the owner that bought it, and over the last 20 years got it to the state where it is now. So the price that was advertised, obviously advertised price doesn't always mean a massive amount, maybe a bit more in commercial than residential, because they are based on some sort of figures and valuations. So he's advertised at 795,000, and so far we've gotten a potentially agreed price of 675,000. And we was able to get that. When I say we, of course, I'm relying a lot on the business partner who's got a lot of experience in this area, and go and like discuss with the owner and the agent, say, look, this is why it's worth what we're offering for it. We did, by the way, attempt a creative deal on here, which was an option to a lease with option to purchase. But as is sometimes the case, the owner needed the money, not because he had lending on here, but he needed the money for other purposes, basically for retirement and some other things. So it wasn't possible to agree that. But whenever we're doing something, we're always thinking, what are the potential creative options? So we did explore that. So here will be a straight purchase. Obviously, we can use lending in commercial. We're talking generally about 70% loan to value. So 30% deposit stamp duty. Yeah, here, this actually is the real stamp duty. So on a purchase of 675, the commercial stamp duty is going to be 18,000. For things that we're doing in residential, we know it would have been something like 40, maybe 45,000. We've got the conveyancing, all the lending fees. Obviously, on these properties, we've got sourcing fee. We're obviously doing work, we're finding them. But if in reality, sometimes you say, why is the sourcing fee 4%? My answer to that be, would you like it to be 5 or 6%? In reality, if you look at that 27,000, if you look at the difference between the advertised price and the negotiated price, probably by going through a deal that we've negotiated, is quite possible that you've already gained twice the, let's say, the reduction in price than someone without experience would have gone in and negotiated. Anyway, that's the explanation. Obviously, we're always paying for you when we're using a good service, whatever that professional service is. Generally, money paid on that is money well spent. Same for the ongoing management. Yes, you can do it yourself, spend half your time doing it, or use an agent that's got really good experience in that. So this would be the money in that's needed to get into this deal. All these figures here come from a detailed analysis which we're able to share. So the valuation at the beginning, in fact, the real commercial valuation based on the current income would be around 729, but obviously we've negotiated the difference on there. And so the immediate return on investment on the money that's into the deal is 8.5%. And then these are the increases over time in income and the increases in valuation. And what we put on here is from year 3 onwards, is if we were to refinance at 70% loan to value, how much money we could get out. So if in year 3 we needed some money to do something else, we get 177 out, so we've still got a bit of money left in. But by the time we get to year 5, it's basically all the money out. So that's one of the deals. The other one is a bit
Trevor,
different.
sorry.
Yep.
Before we move on, so if you go back to the ROI, year 1, year
Yes.
2, year 3. So the reason the rent is increasing and therefore your ROI, is that because the existing lease on acquisition for those tenants that are already in situ already included an agreement that the rent gets increased every single year?
Partly there's that, but that wouldn't explain the amount of the increase.
Mhm.
It's more through the fact that when leases are coming to an end, we will be renegotiating them at a higher value because a lot of the rent's below market value, because the current
Right.
owner is a bit, not gonna say a bit too kind. We have to be kind, but also honest and strict
Yeah.
when we're doing business. Um,
So that reflects the onboarding of new tenants basically to replace previous
that's right.
ones
Yes.
at
Yeah.
market. Okay.
Yeah.
All right, got it.
From what I remember as well, some of the units, for example, probably are not that occupied. They're occupied, but they don't. Some of the people probably don't need all the space that they've got. So there's potential also to say to people, look, at the end of your lease, you've only got 4 people in a space which can accommodate 10. We can do you at the same do it at the same price, but use this smaller office,
And
and then
then
we get
the
twice
yeah,
the rent on the other one.
got it. And then that difference between the advertised price and the negotiated price, is that down to your business partner examining the leases of the current tenants
It's
in
partly that,
situ?
and it's
Yeah.
also partly offer and demand,
Yeah. Okay.
because there's less. Although we've got an in reality as well, and it's sometimes the same in residential when we've got like standard buy to lets. Even though we've got a maybe a good valuation if we're doing a BRR project, we've got a really good because we've done it up to a nice spec and we've thought about things and we've got a good valuation. That doesn't mean to say at any point in time we can actually sell the property at that price, because there needs to be a buyer. It's
Yep.
generally a bit easier to sell residential properties unless we're in a down market. At the moment, it's not quite so easy selling residential stuff. And the same in commercial. There are fewer buyers for commercial, so that gives us a bit better choice. And if we're like, and also sometimes in the case of this one, for example, the owner, it's almost his not exactly his life sort of thing, but he bought it. Maybe it was his parents that bought it, and over time he's like sort of made it really nice. And when someone like that is speaking with people that visibly are going to not wreck it and going to look after it and keep the business going, it also, like, yeah, it's like creating a relationship and trust, and yeah, enabling at the end to often get a good deal.
Yep. All right. Thank you.
All right. Any other questions on this specific one before we move on to the next one?
So I've got a question. So for this particular one, are you planning to continue renting it out as it is, or are you going to do some renovation work, or essentially do a lot of work on it to do something else with it?
Yeah. So this one basically, no, it's a pure investment. So the work on here is almost primarily paper and discussions. So it's optimizing the income and then a bit of ongoing maintenance. And there's also, by the way, a question of sometimes non-experienced property managers in commercial don't realize that the tenants can be paying more things can be put on the service charge, for example. They not necessarily, even though the owner is looking after them, like in a block of flats, a service charge. the same things in these multi-unit blocks. And by understanding what we can charge, what can be charged as service charge, also is increasing the profit, because some of the costs, and that's in the Excel files, that are currently being paid for by the owner should in fact be paid for by the tenants. And based on, sometimes some of the leases don't provide for that. And so it's also a question when redoing the leases to make sure that they're done properly, so that everything that the tenant should be paying for, they're paying for, and it doesn't end up being the owner paying for it. So yeah, in this case,
Thanks.
it's a question of optimization, only a bit of ongoing maintenance. I know in the case of the property that the business partner, is called Duncan, by the way, does have a name, bought a couple of years ago. It was in average condition, so he did spend quite a bit of money improving the condition, but that enabled him also to get better tenants and significantly higher rent. So sometimes on commercial investments, there is going to be also an element of refurbishment and capital expenditure, but obviously for a defined or anticipated return on investment. On the ongoing charges, when we're talking about residential stuff, we sometimes talk about having a pot for maintenance and taking, for example, 5% of the ongoing income and putting that in our maintenance pot. In commercial, we don't call that a maintenance pot. We call it a provision for capex, so provision for capital expenditure. And we've got that, I think, from memory, it's 5% of the income we put as for capex. And also we have on these type of properties, on the income, we've also got a provision for voids. So everything in these figures do take into account those different provisions. So let's move on to the next one. So this one's different. It's still, the thing that we still like about it is it's like mixed use. It's not like, so if you're like sort of buying a massive warehouse, or you have a massive warehouse, it could be like £1 million. You could put the same amount. This one is, the advertised price is 1.1 million. We've got currently negotiated price at 950,000. For that price, you could probably go out and buy, I don't know, maybe 4,000 square meter warehouse, but that would be probably one tenant, which means the risk is higher because you don't have rent guarantee insurance on big commercial buildings. So then that's a bit of risk, because it's probably not the sort of thing that I would do at this stage. Obviously, if I'm buying 10 times £1 million warehouse, each with an individual tenant, it's not so much a problem. It's like if I'm buying 10 buy-to-let houses, if one of them is empty, I've still got 9 out of the 10 that are income producing. But here, when we're looking at like just 1 or 2 properties in our portfolio, or if we're looking at someone who's using their SAS pension and wants to get a good return on this, these mixed use blocks obviously reduce significantly the risk, as long as they're in areas obviously where there's either high demand or a realistic expectation of demand. And these as well, they're not like shops, they're not like shopping centers, where obviously there is like a big risk in buying shopping centers because people are buying stuff online. The only things that we sort of can't really buy online is a haircut or things like that. Or we can't buy fish and chips online. We have to go to the shop and get it. But other stuff, a lot of the other stuff that effectively we can buy online is coming from places like this. People that are selling online, unless they're really small and doing it in their garage, they're renting a unit in a block like this. They've got there maybe 2 or 3 staff, someone doing office work, a couple of people packing stuff, maybe they're assembling things. And yeah, there's, so these, what we call them mixed use, because they can either be offices like small warehouses, workshops. It could be, for example, electronics repair. workshop. And then also these things like we call the micro leisure, which could be, I mentioned like gym and dance class, because another block that we were looking at had tenants like that in it. For the moment, we haven't negotiated a good price on that one, so we're not offering that as a deal, but that might change in the coming months. So what we've got here is, yeah, it's called 4 semi-detached and 2 parades. A parade is basically a long terrace of units. So yeah, 8 of them have already been sold on long lease. So there's a ground rent on those and the service charge. And then there's I can't remember, but something like 20 units, which are like on the short leases with the ongoing income. So yeah, on here we've got the, again, difference of between the advertised price and negotiated price. Again, 70% lending. By the way, it's not that difficult to get lending on these types of properties because the risk is relatively small for the lender. So we've got the deposit needed here, the stamp duty, conveyancing, broker fees, sourcing fee. So this one we're talking about 382,000 going into it to get it over the line. However, on this one, when we get to year 3, based on the provisions, we're able to potentially refinance and get more than all of our money out. So we're talking about, yeah, 407,000 out after 3 years. So that's actually more than we put in. Plus, obviously, when we're talking about all money out, we're only talking here about getting our initial money out. And from the very beginning, we've got our ongoing income in the deal. So yeah, these are the sort of things that we are, let's say, focusing on. There are obviously other types of commercial property. Hotels, service departments can potentially be good. I would say generally restaurants and retail are probably to avoid. Takeaway is probably fine. But yeah, commercial investments can be good investments. Are there any questions on this specific deal, or yeah, how this one works?
Trevor, in terms of financing for these acquisitions, are there some criteria that lenders look for in the new owner? I.e., are they looking for someone who's got experience? You know, does that affect the rate of borrowing like it would do in, let's say, on the residential side, you've got the experienced landlord definition,
Yes.
etc., and things like that. Is that a thing in the commercial space?
Yes, it is. But if you, obviously, I'm selling my deals, but if you take one of our deals, you're also taking our, and in particular, business partners' experience. And when you put the file into the lender, we'd obviously be helping you or helping the investor put that in. And when we give, because obviously the lender is going to want more than these 3 cigarette packet figures here. The lender is going to want all the details, all the stuff that's in our Excel files. And yeah, we'll be helping provide that. And the lender's going to say, how are you going to manage it? So if you go, or if I go and say, I'm going to be managing myself, I haven't done it before, but I think I might get away with it. The lender's not going to be that happy. If, however, you say, look, I know it's how it should be done. I've got an agent or a company that's got significant experience that's going to be looking after it. I'm financing it. I'm just going to be overseeing it, making sure that the agent is doing what he should be doing, exactly the same as if we're renting something out. Then that's fine. That isn't an issue. I mean, there is obviously going to be the standard stuff about personal credit history, which generally isn't going to be a big issue either, because here it's not based on the potential of the lender to pay himself. It's based on the commercial income of the property. Any other questions?
Yeah, sorry, Trevor. I think I overheard you say to avoid restaurants and retail. Is there any particular reason why to avoid them?
Well, I think the particular reason is to go on any high street and see how many vacant shops there are and how many restaurants are potentially closing at the moment. So in other words, it's the risk of not getting the expected income.
Right, understood.
Yeah.
Okay.
Yeah, there's nothing wrong with a restaurant or a retail shop. But if it's something, for example, like a coffee shops, obviously, you can't really have the same feeling of a coffee shop by buying coffee online. So there's like a need for that. But if it's shops, small shops selling clothes or different things, then it could be quite risky. It depends. If it's on a street where there's not very many shops, I've got like not pure commercial, but I've got like forgot mixed use we call them, where we've got a shop downstairs and flats above. As long as if they're in areas where there's basically you look at the street and you see how many empty shops there are, because we've got a deal on the moment. It's probably potentially almost gone. Keith actually was looking at that at one point in time in Ewell, which is close to Epsom, and there was an investor looking at it, and he said, "Well, I don't think much about a shop. I don't know how am I going to be able to rent the shop out." The investor came, and I said, "Look, come." Obviously, I'd done this just before to make sure I wasn't going to say rubbish. I said, "We're going to take a walk down the high street," because this particular building is at one end of the high street. We walked down the high street. It's probably about 4 or 5 minutes walk in reality, and there's probably something like 60 shops on the high street. We walked there and we walked. I think we had a coffee at the end, and then we walked back. And how many shops, empty shops, did we find? 0. So that obviously answers his question. But then there are other places. If you go to, for example, Newport in South Wales on the main street, which is called Commercial Street, there's probably, because we have been looking at properties there, we're actually looking at ones within which investors are bought and looking at changing them completely into residential. It's basically 1 in 2 of the shops are empty. So yeah, just be extremely careful about retail. If it's like, for example, sometimes, and you can sometimes get these at quite good prices. If it's on some like residential estate a bit outside the town centre, where there's like a small row of maybe 6, 7 or 8 shops, quite often now you're going to have a Greggs there, probably a fish and chip shop, possibly a coffee shop, and a few other things. Sometimes those can be quite good because if you can buy the complete block of 7 or 8 of them, because it's serving, and there's going to be your local convenience store, off license, stuff like that. That is really serving a local need. A lot of the people that live there, they haven't got cars, they're reliant on buses. So when they need anything from all the sort of basic things, or probably there might be a barber or a hairdresser there as well, they're going to go there, and that's probably quite a good investment. So it's like case by case basis, but don't take undue risks. Or things like, for example, buying a hotel building and that is suitable for something like Travelodge. There, obviously, you're gonna have a 15 or 20-year lease, and the commercial yield on there is going to be low, which means a very high commercial valuation. So yeah, things like that can be really good deals. We've got 2 minutes left. Any last questions?
Trevor, that valuation you talked about with the low yield, if that tenant moves out, the valuation
you got a big
drops.
problem.
Yeah.
You got, it depends. You got, if you're, sorry, I shouldn't be saying like that. Stupid enough to.
Sorry, Trevor. I didn't mean to sabotage your.
No. I'm going to say if someone's, I'm going to say stupid enough, because you do get people sometimes on these education circuits saying how, I'm going to give my opinion here, obviously, saying how you can, if you get your Costa coffee in there, you can double the evaluation and get a massive amount of money out. That is all well and good, but if you get that massive amount of money out and then that Costa goes, the bank can at any point in time, and those are the conditions of a mortgage. Basically, it's also the same, by the way, on any commercial mortgage. On a buy-to-let mortgage, it's the same. If that property price value goes down significantly, which obviously, because the commercial property is commercial valuation, the bank can come in and say, this property that 2 years ago was valued at 2 million, unfortunately now it's only worth, let's say, 1.4 million. Therefore, the lending is based on 1.4 million. Please pay us back 300,000 within a month. So, I mean, that's maybe exaggerating to the extreme. And obviously it's possible to plan in advance for these things, but yeah, not to over leverage on commercial investment. Right, well, I'm going to stop here. If anyone obviously is interested in these deals, then to contact us and we can give more information. Generally, we need an NDA and then we can share all the detailed figures. And we will be looking on Thursday, potentially about these two deals and like the real example from Duncan, looking at some of the specific figures on these deals. So I hope that was useful for everyone. I'm going to stop the recording and the live stream and have a good evening.
Thanks, Trevor. Thank you.
All right, yeah, bye.
Thank you. Thank you. Bye.
Thanks, Trevor.
Yeah.